Well, we've recently raised our forecast for national house prices in 2021 from 18%, which was a stunning number in its own right, to now 22%. And that, of course, has mainly been because we've seen that housing market hold up really well during the lockdowns in Sydney and Melbourne, and the momentum continues unabated in the other cities. For next year, 2022, we had been thinking 5% for the year, where most of the momentum was in the first half of the year and things would flatten out in the second half. But we've lifted that to 8%. And in 2023, we're actually expecting prices to fall. Now, we had been expecting prices to fall by around 5%, and we still stick with that 5%, but do point out that it's likely that those falls will continue into 2024 as well. So why have we changed those numbers? Well, we have seen the first move by the authorities to start applying what we call macro-prudential controls, and they've lifted the buffer rate at which borrowers are assessed when they're seeking a loan. So that's the first stage, and we think next year there'll be more examples of that, looking at loan to valuation ratios, looking at loan to income ratios. So along with that, the other big factor that I think will be weighing upon the market will be the ongoing expectation that the Reserve Bank, in fact, is going to start raising rates. So we've been of the view since June that the first rate hike by the Reserve Bank will be in the March quarter of 2023. And we think in the second half of next year, the realisation that interest rates are finally going to start rising for the first time since 2009 will start to weigh on confidence in that market. And the fact that affordability will have been stretched to record lows, particularly in Sydney and Melbourne.